Hi learners, Professor Joe here. Well, in this video, we are going to understand basics of option. So this is going to be a series of videos. So if you get time, kindly go through all the videos to understand basics of options. So what exactly is options? Option is a derivative. Now, what do you mean by derivative? Derivative means when a financial instrument derives its price from an underlying asset. Now, before we go into a financial instrument, let us take an example which is easy for a common person to understand. Say, like, for example, tomatoes and tomato ketchup production cost. So, if the cost of tomatoes go up, then the cost of production of tomato ketchup will go up. And if the cost of tomatoes come down, then the cost of tomato production will come down. So now tomato ketchup production or the cost of tomato ketchup production is a derivative of the price of tomatoes. So if the cost of tomatoes go up, the cost of production go up. If the price of tomatoes come down, the price of production comes down. That is what in common language we can call as derivative. Now, when we trade in the stock markets, we are trading in financial instruments. Say, example, we want to trade Nifty options. Then the price of Nifty options will go up when the prices of all the stocks or the major stocks within Nifty will go up, then automatically the price of Nifty options will go up. And when the prices of the major stocks inside Nifty will go down, then the price of Nifty options will also come down. So Nifty option is a derivative of Nifty. It derives its price from Nifty. That is why an option is basically a derivative. Now, why did this entire derivatives and options actually start? So basically, option started as a hedging mechanism. Now, what is hedging mechanism? It is to protect against price fluctuation. So for example, we'll take the same example of the tomato and the ketchup. So the ketchup company owner will go to the tomato farmers and tell them that we'll do a deal. If, say, example, tomatoes are available in local market for, say, 20 rupees. So the owner of the company will go and tell the farmer that I will buy tomatoes from you at 25 rupees. The current market price is 20. I will buy it from you at 25, but this price will remain 25 for the whole year. Now the farmer thinks that, yeah, he is protected from the downside so that if the prices of tomatoes fall down, he will still have a buyer at 25 rupees. And for the company owner believes that if the price of tomatoes go skyrocket like 100 rupees or 150 rupees per kg, then in that case, he will still get tomatoes at 25 rupees because there is a contract, a written contract between both of them. That's what it's called as a forward contract. So there is no regulator in between. It's just between two parties. Now, there were a lot of challenges to this. Number one challenge is non-execution of contract. Say for sake of discussion, the prices in the market go up and the farmer decides it is better to go and sell it in the market. The farmer can come out of the contract and sell it in the market. Or if the price of the tomatoes go down, the owner of the company can go out in the market and buy without the farmer knowing about it. Another challenge is standardization of product. For example, the farmer say, I have got 100 kgs, but the owner will say, I need 150 kgs. Or the farmer will say, I have only 50 kgs. The owner will say, I need 100 kgs. So there is a challenge with standardization of the product weight. The price also, because there is nobody to control the price. It is just between two parties who will decide. And then if there is a major fluctuation in the price, either party would want to drop out of this agreement because for them it's a big loss. Period. Now, in a forward contract, the challenge is the farmer will say, my yield is ready, you come and take it. Whereas the company or the manufacturer will say that, no, I don't have space in the warehouse. So I want it only after 1 month. So there is a period clash also. And transparency, because the company owner can go anywhere out and buy tomatoes. The farmer can go anywhere out and sell tomatoes. So there is no transparency. Now, this is the case of a product, a commodity. Okay. To overcome these challenges in the commodities market, there was the first commodity options market that was introduced. That was in USA in 1973. That was the Chicago Board Options Exchange. Okay, this was the first commodity exchange for options. Now in India for commodities, we have MCX. But this video is all about trading in options. So we will be more focused towards Nifty and Bank Nifty, which you can trade in the National Stock Exchange. Okay. So options can be traded in Nifty, Bank Nifty, stocks, and there are multiple financial instruments in which you can trade options. But this was just a basic understanding that what an option is and why did this option come into the stock markets. Now, if you look at only options, what does actually option mean? So option is basically a right given to the buyer, but not the obligation to buy or sell an underlying asset at a predetermined price and a predetermined period. That means the holder of the option has the right whether they want to buy the option or whether they want to sell the option, because there are two types of option. Basically, there are two types of option. One is a call option and one is a put option. Call is for buying and put is for selling. And in an option, basically, there are two parties. One is a buyer and one is a seller, or one is a holder or one is the writer. We will look into this as we go ahead. Now, to understand options in a layman's language, we will take an example of a construction house. Okay. So this will give you an understanding how an option actually works. Now, say example, there is one person, say I want to go and buy a house. So I went to a builder and I asked the builder that, yeah, you are constructing this house, which I can see. So what is the cost of this house? So the builder says that the house will be ready in 6 months. The cost of the house is 1 crore. But the 1 crore price is the price only for today. And if you want this price, you have to pay me 1 lakh rupee as a down payment. And I will give you a certificate. And whoever will hold this certificate and come to me after 6 months, I will sell the ready house to this person at 1 crore. So I will say, no, 1 crore is too high. So the builder will say, no, it's not high because, our construction, number one, is normally on time. Second, there is a new hospital coming close to this house. There is a new school coming close to this house. There's a new mall coming close to this house. And there is a new highway that is going to get connected. So this is a great deal. And the only condition is that 1 lakh rupee that you're giving as down payment will not be refunded if you will not buy the house at the end of 6 months. So I am happy. I give that 1 lakh rupee and I say after 6 months, I can buy this house for 1 crore. So now there can be two scenarios after 6 months. So let us look at both scenarios. And in both the scenarios, would I want to exercise my option of buying the house? Okay. So scenario number one. So now in scenario number one, you can see there is a delay in construction. The hospital project has been stopped because of some problem. School shifted from this location to some other location. The mall is still under construction and the highway is gone into litigation. Now, if you look at all these conditions, after 6 months, the cost of the house has come down to 85 lakh rupees. Now, the builder and I have a contract that the builder will sell this house to me at 1 crore rupee. And I will get the house at 1 crore rupee only. Now, I have an option whether to go and buy that house for 1 crore rupee or let my 1 lakh rupee deposit go away. So because I am the option holder, I have the right. So I will look at the market conditions and say that if I buy this house, I'm going to get a loss of 15 lakh rupees plus 1 lakh, which I have done as a down payment, 16 lakh loss. I will let go the option. I will take a loss of that 1 lakh rupee. The premium that I paid or the down payment that I paid is my loss. Let us look at scenario number 2. Now, in scenario number 2, the construction has happened timely. The hospital is ready. The school is ready. The mall is ready, and the highway connection is already done. In such situation, after 6 months, now the cost of the house has become 1.25 crores. Now, I am very happy because now I can buy this house at 1 crore rupee because the builder has given me an option. He has written an option and given to me a contract and given to me that I can buy this house at 1 crore rupee, or whoever will get this contract will get the house for 1 crore rupee. Now, there are two things that can happen. One is I do not have 1 crore rupee to buy the house. So I can go and sell this contract to somebody else. I will tell that somebody else, see, this house currently is worth 1.25 crores. You buy this contract letter from me for 5 lakh rupees, and you go and buy the house from the builder for 1 crore rupee. So you will get a house worth 1.25 crores at 1.5 lakhs. So I profit in the down payment amount, or you call it the premium amount in the options world. And the person who is buying the contract will also benefit because the person is getting a 1.25 crore house for 1.5 crores. So because I was the original option holder, I had two options. One, I could sell the option to somebody else and earn out of the premium. Or the second is I could buy the house myself and resell it probably at 1.25 crores. So I had the right to buy in both situations, whether the price was down or whether the price was up. Okay, so now every single term in this, like the down payment, 6 months, no refund, all these things have names. Okay, so when we will get into the real options, we will understand what every single term meant. But this is just to give you an understanding what an option means. That means a buyer has an option. And the seller also has an obligation. If I come to buy the house at whatever price, then the seller has the obligation to give that house to me. But if I don't come within 6 months, then that option belongs to the seller or to the writer. Okay, then the house belongs to the builder, right? The house does not go to anybody else. So this is a real world example of how an option actually operates. Now, when you go into the stock markets, there are two types of options. One is a call option and one is a put option. But if you actually see within the call option and put option, there are two more things that you need to know. And this is a must. In a call option, there are two another options. One is a long call option and one is a short call option. And in put also, there is a long put option and there's a short put option. We are not going to explain these four terms in this video, but we will explain in detail in the coming videos. If you really want to trade in options and you want to make money in the stock markets, trading options, these four options you need to understand very, very well. In these four options, when do you have to enter using which option and in what kind of market you can profit? So if you go for a long call option, what kind of market conditions should be there? If you go for a short call option, what kind of market conditions should be there? If you go for a long put option, what kind of market condition has to be there? And if you go for a short put option, what kind of market conditions has to be there? Until and unless you understand this basic foundation, you will not be able to make money out of the options. And once you understand these four options and why and when it has to be executed, then you will be able to create your own strategies like straddle, triangle, iron condor, butterfly, and there are many more option strategies. You will be able to create your own strategy, but you need to know the foundation. If you understand these four options, you will be very easily able to trade in the options market. Other than just understanding these four types of options, there are some terms also which you need to understand. Terms like strike price, expiry date, premium, ITM, that is in the money, OTM, that is out of money, ATM, that is at the money. What is time decay? What is an option chain? These are some terms that you must know if you are trading in the options market. And then there are something called as option Greeks. Now I'm just taking the names of option Greeks in this video, but because this is a series of videos for basics of options, I will not be teaching you much about option Greeks and the trading strategies using option Greeks. Okay, we will be looking at basic trading strategies in this series of 3 or 4 videos, which we'll be making for options, and where the thumbnail says that please do not trade options until you have seen these videos. Okay, so it is very important that you understand how option works, how the basics of option works. Then only you will be able to make money in the options market. So in summary, we try to understand what an option is for a layman. We try to understand what are the 4 basic types of options. We try to hear, okay, I didn't explain the terms that are used in options. I will explain that in the next video. Okay. And the focus of these 3 or 4 videos, I'm not able to commit right now whether I'll complete in 3 videos or 4 videos. But whether it is 3 or whether it is 4 videos, the series, I will help you understand the fundamentals of each type of option and how you should execute these options, under what market conditions you should enter the market, and how you should enter the market. So that's all in this video of fundamentals of options. Thank you very much. Now, if you love the content that I'm creating, please like and share my videos. And for more videos in finance, stock markets, technical analysis, fundamental analysis, trading strategies, please subscribe to my channel. All I can say is keep learning, keep growing. Thank you very much. Namaskar.